After the US and Israel launched airstrikes on Iran on February 28, 2026, global oil prices skyrocketed and gas prices here in the United States and across the world immediately surged as a result. By March 6th, average gas prices in the US alone rose by 11% within just 1 week of fighting. But when the US removed Nicolas Maduro from Venezuela in January 2026, the market shrugged it off. Venezuela has the largest oil reserves in the world according to OPEC, larger even than Iran's. If Venezuela holds the largest reserves in the entire world, why didn't the US military operation in Venezuela affect gas prices? In energy markets, the crucial question is not just who owns the oil, but who can stop it from flowing. I'm Bryan, welcome to Why with Bryan, let's dig in. Gasoline prices are not set by the president. They are mostly driven by supply, demand, and above all, the price of crude oil. According to the U.S. Energy Information Administration, the cost of crude averaged at a little more than 50% of what drove gas prices over the last decade. So when the price of crude oil spikes, gasoline is quick to follow, as we saw in the week following the first airstrikes on Iran. Iran is important in the global market not only because it has some of the world's largest reserves, but also because of where Iran is situated on the map. Iran borders the Strait of Hormuz, one of the most critical maritime shipping choke points in the world. On a typical day, ships moving through that strait carry about 1/5 of global oil demand, and about 1/5 of the world's liquefied natural gas, or LNG. That is what gives Iran leverage here. It doesn't need to destroy global oil supply. It only needs to threaten a major shipping route that the market depends on, but more on that later. After the strikes, Reuters reported threats to ships, shutdowns at oil and gas facilities across the region, and 150 ships stranded around the strait, and that number is climbing every day. Saudi Arabia shut its biggest domestic refinery after a drone strike, and Qatar halted LNG production. This was not some distant, hypothetical risk. It was an immediate threat to fuel moving through one of the world's most important shipping choke points. On March 2nd, Brent crude rose as much as 13% before closing up 6.7%, while US crude gained 6.3%. Within days, the conflict forced major Gulf exporters to halt shipments of crude and LNG altogether. And if commodity traders see a real chance that supply could vanish, they don't wait for the shortage to come. They price that risk in immediately, and consumers will feel that shock immediately. By March 6th, US fuel prices had jumped more than 11% for the week, with the national average for regular gasoline at $3.32 a gallon, diesel at $4.33. Analysts also warned prices could rise further if disruptions continue. The surge in prices came at a time when normal seasonal factors were already coming into play for the summer 2026. Before the Iran war, AAA said refineries were already beginning to switch to the more expensive summer blend gasoline, and demand was expected to rise with spring break travel peaking in March and April in the US. But seasonal upward pressure only partly explains the price shock. This was primarily caused by the war in Iran. But why didn't we see the same thing happen with Venezuela? Venezuela may hold the world's largest oil reserves, but reserves in the ground matter a lot more when supply is actually reaching the market. When the US removed Maduro in January, the operation did not damage Venezuela's oil production or refining infrastructure. Any added disruption to Venezuelan exports would have limited immediate effect because global oil supply was already ample, and Venezuelan production had fallen to less than 1 million barrels per day in 2025, less than 1% of global supply. At the time of the attack, Venezuela was already a weakened oil producer after years of mismanagement, underinvestment, and decaying infrastructure. And in the near term, the market did not see a major new supply loss. If anything, Trump's promise that US oil companies would invest billions created some optimism about long-term recovery. Some analysts project a possible increase of up to 500,000 barrels per day over the next 2 years. That is, if Venezuela stabilizes and outside investment materializes. There was another important factor too. The global oil market was already well supplied when the US moved into Venezuela in January 2026. Iran was different because traders suddenly realized that global supply was only stable as long as crude oil and LNG kept flowing through the Strait of Hormuz. The Strait of Hormuz carries more than 1/4 of global seaborne oil trade, about 1/5 of global oil and petroleum products, and about 1/5 of global LNG trade. Iran declared the strait closed on March 2nd and warned that it would fire on any ship trying to pass. Roughly 150 to 200 vessels dropped anchor or were completely stranded nearby, and marine insurers began canceling war risk coverage. And while I was writing this story, Iran has followed through on its threats. By March 10th, traffic was still down and tankers were still anchored off Oman. On March 11th, 3 commercial vessels were hit by projectiles, including the Thai bulk carrier Mayuri Nari. That was the clearest sign yet that this was no longer just a hollow threat from Iran. Commercial shipping through Hormuz was still in the firing line, and that was enough to keep transit close to a halt. At the same time, Iran's actions in the wider conflict were disrupting energy infrastructure around the Gulf. Oil and gas facilities across the Gulf region shut down out of caution. Qatar halted LNG production, and major Gulf producers struggled to load exports as storage filled and logistics seized up. Shipping through the strait went from 37 daily tankers before the war to 0 by March 5th, while Iraq, Saudi Arabia, Kuwait, Qatar, and the UAE are all cutting output and exports as the disruption spreads. That is what gave Iran so much leverage in this conflict so quickly. Iran only needs to make Hormuz dangerous enough that shipping stops, insurers reprice the risk, and oil jumps immediately. And that puts pressure on the US and its allies because higher crude prices quickly translate into higher gasoline prices, inflation, and consumer frustration. By March 10th, the national average gas price had topped $3.50, and analysts said that $4 was possible if disruptions persist. The blockade on Hormuz gives Iran a bargaining chip in this conflict. Relief comes if the attacks stop. Higher oil prices may help on any barrels Iran still exports, but that's secondary. Iran's strongest leverage in this conflict is not monetizing the oil it produces. It is raising the economic costs of continuing the war for everyone else. On the other hand, Venezuela didn't control a choke point that the global economy depends on. So it literally wasn't in the position to impose a de facto blockade on regional energy flows. Even if Venezuela would have tried to take the somewhat nearby Panama Canal, for instance, it wouldn't have had the same effect. The Panama Canal can be bypassed by going around the southern tip of South America. Expensive and less than ideal, but it's still an alternative option. The Strait of Hormuz, on the other hand, has no alternative maritime route, just some pipelines out of the UAE and Saudi Arabia, but these can bypass only a fraction of the volumes that normally move through the Strait of Hormuz. And as long as crude and LNG cannot move normally through the Strait of Hormuz, pressure on energy prices is likely to remain elevated. On March 9th, Brent crude surged to nearly $120 per barrel, the highest since 2022, as Gulf output and exports were still being hit by the disruption. On March 10th, the price swung back to about $85 per barrel, at least at the time of this writing. But this is still about 25% higher than oil was just a month ago, $67.61 on February 10th, and over 40% higher than it was at the beginning of 2026, $60.24 on January 2nd. That is why Iran shocked energy prices immediately where Venezuela did not. Venezuela was a weakened producer where the market saw upside potential in terms of crude output. Meanwhile, Iran was in a position to squeeze one of the world's most important energy arteries. Venezuela had reserves, but Iran has leverage. And in energy markets, leverage over a choke point can matter far more than oil still in the ground. When Iran turned the Strait of Hormuz into a pressure point, it did not just threaten its own exports. It threatened the flow of energy the world depends on, and they won't give up this leverage without a fight. If you found this breakdown interesting, please like and subscribe for more content like this in the future. Thanks for watching.